So Ankit Goel ji, he is a chartered accountant of profession, and also he has LLB degree, and he is a registered valuer. He is a founder and partner of AAA Valuation Professionals LLP, and also a founder partner of AAA Insolvency Professional. He has been in the past a regular speaker for insolvency, valuation, and forensic audits, be it in the NIRC of ICI or in many of the SHM and other industry body as well. So he is a young and dynamic chartered accountant and assisting many of the professionals in clearing their valuation exam and also in conducting many of the valuation assignments. He has been in the past conducted more than 70 financial valuation assignments in the past 8 years. So that is why he will be assisting all the participants and guiding them for the valuation application. Over to you, Ankit.
Thank you, Manas. Thank you. So I will just
all the participants are in the unmute mode is basically disallowed just for the decorum of the class, but the participants can like start their video.
Okay, so I think what you can do is you can also allow people to unmute, but I will request everyone to keep themselves muted unless and until they're speaking. So that will help us have an interactive session, and that should help having an interactive session.
So you can just ask any query, you can ask in the chat box as well.
So you can just allow me to share the screen.
Yeah, sure.
Yeah, got it. So I hope everyone is able to see my screen. As I discussed, this topic of valuation approaches is very close to everyone's heart. It talks about how the various methods are used for valuation purposes, and the practicals are also very, very closely associated with this. So we'll try and do our best to concentrate and have an interactive session. I will have Q&As from time to time, which will further help all of us enhance our knowledge and test the same. Just a second, I'll just configure my screen. Yeah. So, what is the valuation process? If you look at the valuation process, generally speaking, you first try and understand the business and the key factors that influence the business. You do a planning and preparation, you do a review and of the forecasting techniques used by the client, review of the future projections which are provided by the client. You select the appropriate valuation model and then you apply the sensitivity analysis on the projections. You select approaches and methods of valuation which suit the valuation. You apply various adjustments. You conclude the analytical results in the form of recommendations and then pass on your conclusions. So if I say that yes, valuations is not about that Excel sheet. Valuation is much beyond that. Valuation is about understanding the objective of the valuation, understanding the economy, understanding the marketplace in which the business or the entity that I'm trying to value, the shares I'm valuing, where are they getting their value from? Because value at the end of all things is the perceived value for the people who are used in the market. In case I talk about a market value, in case I talk about an equitable value, it becomes the value which two people have agreed to divide between themselves. So this is how the structuring is done with respect to the process. It is important for you to understand the process, for you to realize that no, the valuation approaches are a part of the whole game. To determine which approach is the most appropriate, I need to understand the business, I need to understand other aspects of the industry, the economy, and so on, as well as the purpose of the valuation. Before I proceed, I want to understand if anyone can tell me amongst the audience the difference between basis of value, premise of value, valuation approach, and valuation method. These four are different concepts. I hope everyone understands that these are different concepts. What are these four different concepts? How are they different from each other? Anyone can also just unmute their mic and tell me if they know that, okay, what are the known valuation premises, what are the known valuation methods, what are the known valuation approaches that are known to you? Anyone? I hope you're able to unmute yourself.
Yes, can I try?
Yes, Chandraji.
Basis means what is the base of valuation? These three measures are there, like fair value, participant specific, and the liquidation value. What would be the out of these the basis? On this basis, we need to be further to be decide the premise.
Okay. So, any inputs on the premise approach and method? I think you're fairly accurate about premises.
Premise means what is the
fairly accurate
assumption?
about the basis. Yeah. Please go ahead.
Then the premise is the assumption that what is the use of that assets. Okay. What is the best use? Like there are five factors: Habu, orderly liquidation, as in varies, and forced liquidation.
Great, so very accurate, very accurately said. What about approaches and methods?
The approaches are what is the approach to calculate the final valuation. There's a market approach, cost approach, and income approach.
Great.
And there are the further methods are there in particular each of these approaches. In the cost method, there is a replacement cost and cost replacement method, cost reproduction method, and then in income approach, there is a DCF method, discounted cash flow method.
Great. I think you've accurately said everything. So this is the difference. Whereas the premise talks about the use, the basis talks about the definition of value that I want to take out. In various circumstances, the value can be of different, can have a different basis. So what are we looking when you're doing a value? You're putting yourself in the shoes of the transaction that is going to take place. So you're basically assuming that a transaction will take place, right? That is what you're trying to value. That is the value that you're trying to achieve. So you're assuming a transaction. You're assuming the parties to the transaction, and you're assuming the date of the transaction. If any of these three things change, the value can be different. So the valuation that a valuer is required to take out as per IBS 104 also talks about the idea that there has to be an assumed transaction, date of transaction, and assumed parties. Then it says that depending on the basis of value, the assumed transaction could take a number of forms. What are the number of forms? The number of forms are it can be an hypothetical transaction, it can be an actual transaction, it can be purchase or entry transaction, it can be an exit transaction, it can be transaction in particular or a hypothetical market with specific characteristics. Then coming to assumed date of transaction, the idea is that the date of transaction is very important. Today, in case in IBC valuations, I say that the date of valuation is the CIRP date. I am not allowed legally to go beyond the CIRP date. If today somebody says, "Oh, value this company," the CIRP date was just before December 2019. At that point in time, there was hardly any COVID impact. But today, in case somebody tells me, "Oh no, the valuation date is not that date, the valuation date is today," then maybe I will consider valuation COVID impact on maybe an industry which is affected by COVID heavily. So most basis of value then derive talk about certain level of description of the parties. So with respect to parties, there are certain characteristics that are assumed. They are hypothetical parties. We don't know who the parties are. Alternatively, there can be known or specific parties. So if somebody comes to you and says, "I want to sell my business in the market, please tell me what is the value." You might have a different approach as compared to somebody coming to you and saying that I want to sell my business to XYZ. Please tell me what is the value I should sell that person the business to. When I talk about a specific person that I'm selling my business to, then I am supposed to consider all the synergies that that person might have acquiring my business. What is the negotiation? What is the eagerness of the other person to buy my business? What is my eagerness to sell the business? And sometimes, we probably want a market value, and the seller is very eager to sell. He just wants to sell because he has so much debt lying on his back. So he wants to sell immediately. But in case you talk about a market value, maybe you are looking at a market where there is no eagerness to sell unless and until the seller gets the just price. So this is basis of value, and the basis of value are these. When you look at market value, assume that the seller is a fair seller. The seller is not the specific person. The buyer is a fair person. Everyone has seen the asset, seen the share. They have done all the prudence. They are all knowledgeable people. So you say the market is not you don't have fools in the market. The market is a very, very wise system wherein everyone has knowledge with respect to what they're getting into or what they're getting out of. So in case today somebody tells me, "Oh, Zomato share, look at where the share is going," I go back to them and tell them that it is difficult to say perhaps that so many people are not investing in a share based on some research, some homework, and they don't see future value, but they're still ready to invest today. So it's difficult perhaps, but yes, market is the true driver. Therefore, the stock market prices that we get, we always assume that yes, these have some sacrosancy with respect to the value of the company underlying, which is on which the value is based on. When you talk about market rent, equitable value, where you talk about identified parties, investment value, you say, oh, what is the value to a particular owner? Synergistic value, you look at the combined value, which is more than the sum of parts. Liquidation value, you assume that everything has to be sold on a piecemeal basis, and so on. So the idea is that these are the basis of value. So somebody tells you, compute fair value under Ind AS. You will follow the definition given under Ind AS, not the market value definition stated in IVS. Other values are intrinsic value, fair value as per Ind AS, and so on. So coming to the next part, that is understanding the basis of value. So basically, we are saying that the value should consider instructions and inputs received from the client, and he should not use a basis which is not appropriate for the purpose of the value, as I talked about it before also. Then the idea is that we come to the premise of value. So as Chandanji conveyed, that premise of value talks about the use that you're looking at. So highest and best use, current use or existing use, orderly liquidation, forced sale, these are the premises of value, where you say, what is the asset going to be used for? So supposedly, I tell you that we have an investment into a real estate property. That real estate property has a one-story house constructed on that. But yes, the government and the regulations, building bylaws allow somebody to just pull down that structure and construct 4 stories. Will you value that property based on, or value that land based on the rental value that one single story house is giving you? I don't think so. So market perception of that property will be that somebody will say, "Oh, we will pull down this structure. We will build a 4 story house. We will sell each of those stories to independent people, and yes, maybe we will have some construction cost. Maybe we want to keep some profit for ourselves, and that is the balance that you get is the value of the land." So this is how the market looks at the land. And what is this? Is this the current use of the property? No, it is the highest and best use, which is legally possible in this case, which is physically possible in this case. So that is what you will see whenever we look at market value. Normally, we look at highest and best use. Sometimes where there is a legal limitation, therefore it is necessary to look at the documents, look at what are the users, possible users, look at the shareholders agreement when you are valuing a minority shareholding. You need to understand, oh, what are the exit options? What is going to be the value that this person is going to receive in case he sells these shares? So in a private limited company where the shares are not sellable freely and somebody has a 5% shareholding in that company, will there be a value to that company? Will there be a strategic value to the company? I think yes, it might be very, very difficult to say that yes, that value of that 5% shareholding will be equivalent to the or the per share value of that 5% shareholding will be equivalent to the 95% shareholding that somebody else owns. So that is what is required to be taken care of. Coming to valuation approaches, which is the subject that we're supposed to look at, we're looking at 3 approaches: market approach, income approach, and cost approach. And this is what is part of our syllabus also. Before we proceed, we want to understand, or I will like all of you to talk about what is the association of these economic principles that are on your screen. Economic principle of price equilibrium, anticipation of benefits, or substitution. So I will request somebody to give me an example of price equilibrium or economic principle of price equilibrium maybe an imaginary case, and which approach should price equilibrium talk about. They encourage all to participate. You can't go wrong. If you're participating, you will only be adding to, further adding to your knowledge. Trust me. So try it out. What is price equilibrium? Give me an example and tell me which valuation approach does it belong to.
Price equilibrium means balance of the price.
Balance of the price. Okay.
Example, I am not aware, but I think it will applicable to the market approach.
Mhm.
That's the things I know. This
You're very accurate that this is his market approach. Anyone can give me an example? Maybe an example from an SFA valuation that you might have seen, looked at. What is the economic principle of price equilibrium?
demand and supply.
Demand and supply. Okay. Can you elaborate further?
If the demand is high, supply is high, then demand will be low, and demand will be high, then supply will be low.
Okay. Okay. Any
The
other inputs?
inverse relationship between the demand and
Got it. Got it. Any other inputs from anyone else? Yes, Divakarji.
Yeah, putting the price in which both the parties, buyers and sellers, are comfortable to go further with the transaction.
Okay. All right. So that's a price at which the buyer and seller will go ahead with the transaction. That is your say. Anyone else who thinks that what is this economic principle of price equilibrium? Is this about demand and supply factors, or is it about something else?
And overvalue in between.
Sorry, Rajmohanji.
Right.
Sorry.
Sir, where the demand and supply and the undervalue and overvalue principles also will come. And the buyers and sellers might also believe that this is the apt price.
The undervalued, overvalued principle will also come into place. That is what you're saying. That yes, other than the demand supply gap, that will also demand supply factors. The underlying the other part will also be important.
And both buyer and seller believe that overvalue is
Okay. Any other inputs? When I look at something and I say that, okay, let me talk about an iPhone 11 versus an iPhone 12. Are the prices of these two phones different? They are different, right? So can I say that in case I see both these phones and I want to value one phone, or I want to look at the perceived value of one phone, I can in some way relate that this phone and this phone have this kind of a price difference? Or can I say rather that when I go to the market and I say that, oh, this Apple phone is this much, this Samsung phone, which is also the latest phone, is this much, and this is the price differential between them. I always take a call on how the prices, or there has to be an additional value that I get or somebody gets from buying one product over the other. So in the market, in case I want to buy a laptop, one laptop say is having the latest Intel chip, and the other one is an older one. Will you ever buy the laptop which is with the older chip version in case that laptop is more expensive than the one which has the latest chip? You will never do that, right? You will always say that I want to pay more for maybe something better, but otherwise I will not like to pay more. That is the concept of price equilibrium. Let me put that into perspective with respect to two properties, maybe two 500 square yard plots in a South Delhi colony. You see one, you see the other. Both of them are maybe say corner plots. One seller is willing to give that to you for say 10 crores. The other one is willing to give it to you only for 12 crores. Will you buy the one which is 12 crores or the 10 crores? So this is also the concept of price equilibrium. So now like another example. You come to know that your friend has bought a plot of land in a certain place for an X amount of money. You go and you also want to buy it. Say the transaction was very, very recent. What is the chance that you will end up, or you will try and buy, or you will be okay with buying that plot at, say, even 1.2x of the price that your friend paid. You will look forward to pay the same price or maybe even lesser price in case you can bargain for that plot of land. So price equilibrium concept of the market approach tells or assumes that in the market, in case there are two things which are similar to each other, both of them have to be valued the same. Both of them have to have the same value. This is the economic principle of price equilibrium. That in the long run, when you look at two different items, then their price will be absolutely the same unless and until they are different in some manner or the other. So say there is one stock called HDFC Bank, there is another stock called ICICI Bank. Now both of these are valued by the market continuously in the stock exchange. And ideally, in case HDFC Bank goes up, ICICI Bank perhaps will also have some effect, because many people will think if HDFC Bank is this high and all the ratios of HDFC Bank, all the trust that we have in the management is replicated to the second bank, then the value should increase proportionately, or based on some factor, based on the increase that has happened in the first share. So this is economic principle of price equilibrium. Coming to economic principle of anticipation of benefits. Can somebody give me example of anticipation of benefits? Maybe somebody has made an investment in anticipation of benefits. Maybe somebody has done a valuation where they have anticipated future benefits that might arrive to them. So anticipation of benefits is income method. Everyone should understand that. Now, anticipation of benefits, when it is income method, in that case, what happens is that you look, or the valuer tries to look at future potential of benefits that might come to the person who is holding maybe a particular share. So, what are the future benefits that we expect out of a share, out of investment into a share or investment into a business? Future cash flows can include profits. Future cash flows can include realization from maybe some sale of certain assets, right? So that's anticipation of benefits. A shareholder might be looking at dividend. A shareholder might be looking at an increase in price in the future, right? What about substitution? Can you give me a substitution example?
They can disinvest the particular share and invest for another share.
Okay, so they substitute the share with another one. What will be the objective of doing the substitution?
Objective to get the more return. If some share is not giving the good return, then another is giving.
Very well said. So that's the cost approach. Alternatively, cost approach also works in the way that, if you want to say, cost approach one normally is not very often used for valuing shares or valuing going concern entities. But the idea behind it is that, say you're looking at a building, and let's understand that you say, oh, this building will require, if I want to reconstruct this building, I will have to spend this much money. So if somebody is buying that building and that building seems to be useful for him, then the substitution concept will tell him that he should value the building, and then value the building and add the value to the based on the expenditure that would be incurred to substitute that building today. Similarly, in case you look at plant and machinery, there also the cost method or substitution method works, where you say that, okay, this is a machine that I'm using, and if I will go to the market and try to buy a new machine or a second-hand machine, this is the value that I will get. That is the economic principle of substitution that we talk about. And these are the methods. Now, within market approach, you have a comparable transactions method, you have a guideline, publicly traded comparable method, you have a rule of thumb method. Then in income approach, you have DCF and various varieties of DCF. Then cost approach, you have replacement cost method, reproduction cost method, and summation method. So valuation approaches can be of these types. Coming to market value, I think I've already talked about how market value is defined. I have not put in more time here, and I've also talked about the premises of value, and we'll just skip that part. Now, the goal in selecting valuation approaches and methods for an asset is to find out the most appropriate method under the particular circumstances. So, no one method is suitable in every suitable situation, and the selection process should consider at a minimum the appropriate basis of value and premises of value determined by the terms and purpose of the valuation assignment, the respective strengths and weaknesses of the possible valuation approaches and methods, the appropriateness of each method in view of the nature of asset, and the approaches and methods used by the participants in the relevant market. So basically, all these things should be taken care of when you're identifying a method to be used, and therefore that part is very important. And the idea is that the valuer can use more than one method, and unless and until he has a high degree of confidence in the accuracy and reliability of a single method, he should try multiple methods and see which one seems to be more genuine, more possible, or practically possible. So, however, valuers should consider and understand insufficient factual or observable inputs for a single method to produce a reliable conclusion. So, basically, that's what you need to do. Inclusion of value based on those multiple approaches and methods should be reasonable and without averaging. So the idea is that you should average, you should say, oh, cost method का एक method ले लेता हूँ, income method का एक ले लेता हूँ, और market method का एक ले लेता हूँ, और तीनों का average कर देता हूँ. So that's not something that IBS kind of says. IBS says you gauge which one is giving you more comfort. Try to come out with a scientific explanation on which method will be more suitable. Then, while the standard includes discussion of certain methods within the cost, market, and income approach, it does not provide a comprehensive list to choose a method. So, one can choose other methods which are not listed. Then, when different approaches or methods result in widely divergent indications of value, the valuer should perform procedures to understand why value indications differ and determine whether one of the approaches method provides a better or more reliable indication of value. Then you have to maximize the use of observable inputs or observable market inputs, market information, and then you have to perform appropriate analysis to evaluate those inputs and assumptions. Then price information from an active market is generally considered to be strongest evidence of value, which is again, from a dead market or from a non-active market. Active market price is considered to be more appropriate or more accurate value that should be used as a comparator. Then, depending on the limitations based on the value and the procedures performed, such circumstances may result in a valuation that is not IBS compliant. And the valuation may be limited or restricted where the valuer is not able to employ the valuation approaches. So, valuation approach is given significant weight when the subject asset has been recently sold, the subject asset or substantially similar asset are actively publicly traded, and there is frequent and recent observable transactions in substantially similar assets. So the following are some additional circumstances. I think we can give a miss to this, but the idea is that the assets are not recent enough. So in such circumstances, you can consider market approach, but the IBS tells you that you have to consider market approach only if the other methods are not working for you, or they have some issues, or they have some problems, or they are not accurate enough. Their information usable for them is not available. That's what needs to be understood. Market-based inputs should be maximized, and comparative analysis of qualitative and quantitative similarities and differences between the comparable assets and the subject assets. The selection of the appropriate multiple within the range requires judgment considering qualitative and quantitative factors. So, in few recent transactions, have occurred, the valuer may consider the prices of identical or similar assets. So, one idea is that you look at the same asset. You say, oh, what has happened with this asset recently? Then the IBS says, okay, if you don't have a recent transaction for the same asset, then you can look for identical or similar assets that are listed or offered for sale, and that is the next order in which you can try and find out an alternative that is suiting you. And sole indication of value. Sometimes comparable listings method, and it should not be used as sole indication of value, but can be appropriate for consideration together with other methods. That is what the idea is. Level of commitment inherent in the price and how long the listing offer has been on the market. That's also something that should be given a weight of. Then a few of the many common units of comparison used in business valuations include Ebitda, multiples, earnings multiples, revenue multiples, and book value multiples. So this is what we will be discussing in detail on how these multiples are used. And this is basically the main idea behind uh, market approaches which are used in the purpose or for the purpose of uh, valuing shares and securities and financial assets. So what is EBITDA multiple? I don't think I need to repeat because most of you would already know that EBITDA is what is EBITDA. The enterprise value is used to compute EV by or enterprise value by EBITDA, and the idea is that the enterprise value is of course the market capitalization of the equity plus the debt minus the cash. Then we have EV by EBITDA, so that's again enterprise value divided by the EBITDA of the company, and that gives us a ratio which is EV by EBITDA, which is globally used to compare different entities. So today, in case, why do we use EBITDA and why not the post-tax profit? Anyone? What is the logic behind that? Yes, Sebapiji.
Yeah, because we are valuing the company, not the stock.
Okay, so because we are valuing the company, we are using this
Claim
EBITDA.
holders,
Yeah.
both equity holders and debt holders are both can claim on this profit.
Okay. So we say that when we use EBITDA, we are saying that what are we not reducing? We are not reducing the interest. We are say not using the taxes. We are not reducing the depreciation. So we are coming closer to the cash flow that is available to the company or available with the enterprise to distribute the same to its stakeholders. And in this case, in a enterprise value system, we say that the enterprise is valued at a certain amount, and then yes, it has a debt to pay. So yes, when you're valuing the equity shares, then maybe you will have to subtract the value of debt. But when you're valuing the business should also include the debt that the business has taken, because normally it is understood that the debt level in a business will continue, and those debt levels will be a long-term debt, and therefore that cost will be a ongoing, permanent kind of a cost. Then there is earnings multiple. What is the earnings multiple? The price earnings ratio is also sometimes known as the price multiple or the earnings multiple. It is the ratio which is calculated by dividing the market value price per share by the earnings per share, and the most common measure of valuation using a multiple of accounting earnings. So the idea is that what you need to understand is that the earnings multiple and the earnings multiple is used for the purpose of valuing different companies. In case somebody has an earning of 2 and the 2 rupees, and the other person 2 rupees per share, and the other person has an earning of 4 rupees per share, and we say that no, everything else is equal, everything else is absolutely the same. So maybe the value will increase by 2 times when we are doing the valuation of that other project. Coming to revenue multiple talk about comparing the company's stock price to its revenues. So also known as price to sales ratio. It also gives equity value, and that is what the revenue multiple does. Then book multiple. So book value multiple is basically the ratio of market price of a company's shares over its current value of equity, and the book value of equity in turn is the value of a company's assets expressed on the balance sheet. Comparable transaction method involves the following steps. Step number one is to identify the unit of comparison. The unit of comparison, as I said, can be Ebitda, can be the book value method, can be various other comparisons that one wants to do. It can be capacity related. It can be, very different for various companies. And the unit of comparison should also be selected based on the business in which the company is engaged in. Then identifying the relevant comparable transactions and calculate the key valuation matrix for those transactions, consistent comparable comparative analysis of qualitative and quantitative similarities and differences. Then necessary adjustments need to be passed. Then apply the additional valuation matrix, multiple valuation matrices are used, reconcile the indications of value, and that is how you would complete the process. So a valuer should choose this method, especially where there are several transactions that are available, that the asset is very similar to the asset that you're procuring or you're getting into. When the transactions happening closer to the valuation date are more representative of the market, and then then transaction should be arm's length between unrelated parties. Then sufficient information on the transaction should be available to allow the valuer to develop a sustainable understanding of the comparable asset and assess the valuation matrix. The information on the comparable transaction should be reliable and trusted source. Actual transactions provide better valuation evidence, and so on. Then quickly we will talk about some differences that might come up in two assets where you're trying to value one asset based on the available ratios or values of the other share. So in case you have a market transaction which has happened in an XYZ company which is into, say, banking sector, and then you have another transaction coming up in the same sector for a different company, then you can in fact use that with customization based on the characteristics that are different and so on. So material characteristics are not very relevant for SFA. Relevant transactions of either the subject or the comparable asset, geographical location, then profitability or profit making capability of the assets, historical and expected growth, yields, coupon rates, types of collateral, unusual terms in the comparable transactions, differences differences related to marketability and control characteristics of the comparable and the subject asset, and ownership characteristics. So these are some methods for these are some basically adjustments that are required to compare two transactions. Coming to the next part, that is guideline publicly traded comparable method. What were we doing here? We were looking at a transaction. We said we will look at a transaction and we will look at that transaction first priority, the transaction that has happened for the same stock. Then we said we will go to the similar industry and see what their stocks are trading at or valued at. And then we will perhaps take a decision on comparable transactions method. That is, there was a transaction that happened for the company or for the group company or from the industry, and that is what we want to use. Publicly traded company method, you simply do what? You have a live price going on in the markets, in the publicly traded market, and you have those values. Now, of course, what you can do is you can have a system where you can try and understand, okay, what was the value of this share on this date, and based on that, you can kind of develop your model where you find that your company is very close to the publicly traded company that you're trying to value. Other market conditions, so it says that this is a non-exhaustive list of considerations that may be part of a market value, and one can always add more. Further, the in IBS and our syllabus also talks about a anecdotal or rule of thumb method, where the benchmarks are sometimes considered to be a market approach, and however the value indications derived from the use of such rules should not be given substantial weight unless it can be shown that buyer and seller place significant reliance on them. So any example of rule of thumb valuation that comes to your mind? Anyone? Rule of thumb valuation.
50%.
50% of what, sir?
I mean, the value which you derive, the past value, the thumb rule, what I remember is 50%.
Okay. Any other input?
You can refer some previous merger and acquisitions.
Okay. So we can refer to some previous mergers and acquisitions, and then how do you compute a rule of thumb?
It's a kind of benchmark, like you can say that earlier some like Flipkart has got some valuation on that basis, got funding on that valuation basis. Then if supposing if within a month or 2 months or reasonable time, Amazon goes for the funding, so that kind of benchmark used for that using the Flipkart valuation.
So basically, rule of thumb method talks about the idea that in certain cases there is a possibility that you can simply say that, oh, this share or the value of this share is these days this much. So say at one point in time when all the deal making was going on in the restaurant industry, some people used to say that the value of a restaurant stock is Rajmohanji, can you please mute yourself? So some people were saying that the restaurant industry is seeking a lot of investment, and the general rule is that if you will get 3x or 2x of your revenue, right? So that was a rule of thumb method. Similarly, in case we look at a plant and machinery kind of a thing, or maybe we look at a power plant in plant and machinery, there also it is very very common that somebody says, oh, we have a plant and machinery, and we have this capacity of say 300 megawatt, and we will just compare the valuation with that number that we have available. So that's a rule of thumb method. Somebody can say, oh, okay, we have a value per employee. Somebody can say we have a value. Somebody can say we have a value per user, right? So these are all rule of thumb methods where market kind of can have interesting ways to give value to a certain entity or their shares, and that's what is captured in the rule of thumb method. Any further questions on this?
One question also, P multiple of particular industry can be used as this rule of thumb.
That would not call itself a rule of thumb, sir, because if you use that, then you will normally fall into the comparable price method. So you will normally rely on the comparable value and then do it, rather than saying that it's an anecdotal method. Yeah. Any other questions from anyone else for whatever I have talked about till now?
One thing, just want to more elaborate on that. In which conditions we can't use income approach, like you also said in that PPT. So such
We'll come to that. We'll come to that when we talk about income approach. So in the market approach, the fundamental basis for making adjustments is to adjust or for differences between the subject asset and the guideline transactions or publicly traded security. And some of the most common adjustments made in the market approach are known as discounts and premiums. So what is a D-long? What is a D-log? What is a blockage discount? Let's try and understand that. So D-long is discount for lack of marketability. When do we have a discount, or when do we need a discount for lack of marketability? When we say that the price or the share that I'm comparing the value that I'm taking for which is having an extremely high marketability in the exchange, and my own share, which I'm trying to, my target company, which I'm trying to value, their share is highly illiquid. So how will I value these shares? Do you think that yes, one share is easy to sell, the other share is difficult to sell? Should they both have equal value? Maybe not. So the discount for lack of marketability talks about the idea that um, one can um, one can have assets, and then the discount for lack of marketability reduces certain amount of the value that is computed to come out with the net value. And in these cases, the discount for lack of marketability is anywhere between 5% to say 30%, depending on what condition is the asset and how readily sellable it is. Then coming to D-Log. So D-Log talks about all assets being equal, participants would generally prefer to have control over a subject asset than not. So the idea is that in case of a control, we need to see that should control demand a premium? Should control of some shares or some company have a premium? And if yes, then why? Why do we say that 51% or 50.1% is better than 49.9%? What is the difference? What does control give me?
Rights over the company, over the assets of the company, like voting rights or asset rights in the profit.
Rights in the profit are available to everyone. Voting rights
Voting-
are also available
voting-
to everyone. 51.1 also, 49.9 also.
Significant control over, means participant to appoint the directors of the company or to take the decision of the big decision of the company.
Mm-hmm.
To control over the company decision making.
That's okay, but then that's power. But then, how does it translate into value?
Basically, like if the company's value is, we are getting less power, less percentage of the shares. That is that we can't control over the company. Like we are a minority shares.
Okay.
That can be means.
So, what is that control? Like, that's what I'm trying to ask. And what is that control, and how does it affect the value of the shares? So the idea is that when we look at control, we're saying that if somebody has control, that somebody can then take decisions which can perhaps grow the business or develop more synergies in the market. And that is why the discount for lack of control or discount or control premium for the shares where you have a controlling interest is important. So 26% shareholding in a company, there the per person cost will be uh, per person share value will be perhaps lesser than the other part. Then there is a blockage discount. Blockage discount is where you have large sized values or large sized blocks of transactions that are required to be executed. And maybe the blockage discounts will mostly come in where, because of the large shareholding that you're selling, maybe a few people will be there might be a demand supply gap and so on. So that is blockage discount.
So there is one more I think which I am thinking about that. One was the percentage of non-going concern. That what would be the out of this
Percentage of
non-going concern? Well, a percentage of being shut down of the company for the startups that have more chances to be closed at early stage, not to be grown 2 to 3
Yeah,
years.
so one can always give a discount, and one can say that that is more of a probability system where you say, oh, there is a 10% chance of this business to fail. If it fails, then I will realize zero sum of money. And if the business does not fail, then I am developing a model where I can give a value. So in that case, what happens is that one can take the value, or just a second. I'm so sorry, there's some disturbance in the background. I was just sorting it out. So, as I said, there is this adjustment with respect to, as Chandanji was saying, that there's this adjustment on probability of failure. And that probability of failure is something that is, of course, very, very relevant for certain companies which are understood to be high risk companies. In some cases, this probability of factor is accounted for or taken into consideration in the as a percentage. Say you say, oh, there is a 25% probability failure, so you put 75% and take a value. If you have a 10% chance of failure, you put a 90% value of the value of the stock value that you have otherwise computed as the value. So that is the kind of difference that we have. Blockage discount, I think all of you know. So in case today, Mr. Mukesh Ambani decides to sell some major shares of his holding in Reliance Industries, it's a blockage discount. Too many shares in the market with very few buyers, right? Something like that. So then there is a discount for lack of marketability. That's D long. So discount for lack of marketability should be applied. So this is what we discussed, that it should be applied wherever the comparables are deemed to have a superior marketability than the subject asset. Then there are many bases of value. Many bases of value allow consideration of a restriction on marketability, and that's why some restriction is therefore then put in place through a percentage reduction. Then there is discount for lack of control. It reflects the differences between the comparables and the subject asset with regard to the ability to make decisions and the changes that can be made as a result of exercising control. That is what a person is paying for, and somebody will generally prefer to have control over a subject asset than not. And then whether the ability to exercise control enhances the economic benefits available to owner of the subject asset. Control premiums and DLOCs may be quantified using any reasonable method, but are typically calculated based on either an analysis of the specific cash flow enhancements or reduction in the risk associated with control, or by comparing observed prices paid for controlling interest in publicly traded securities to publicly traded price. So when applying the guideline publicly traded method, the value of subject asset that reflects the controlling interest, a control premium may be appropriate, and otherwise, if you're looking at a minority interest, then maybe the other method can also involve a control adjustment. Blockage discount we've already discussed. Some other adjustments can include contingent liabilities or assets. So these are adjustments that are done in the earnings. So in case you see a contingent liability and there is a high likelihood that this contingent liability will become an actual liability, then it becomes important for adjustments to be made with respect to the same. Then there are surplus assets. What are surplus assets? Non-operating assets. What are non-operating assets? Assets which are not part of the business, which are not being used for the business by the participants. So in that case, there is this adjustment that can be brought in. Then there is a tax concession. Tax concessions are very rarely adjusted for. They are frequently adjusted for in case of intangible asset valuation. But even there now, with respect to goodwill and other, goodwill or some other not clearly visible assets, it is difficult for now to look at a tax concession after the recent amendment in the budget. So it will only remain with goodwill and not with other intangible assets now, this kind of a tax concession. auditor's qualification, findings of due diligence reviews. So these adjustments are also done frequently, where somebody, maybe a DDR tells you that, oh, this amount of sale which is being considered as part of the financial statements of the company does not belong to the company because of some reason. Or maybe there is something which is, some value which is shown as receivable, but actually it is something that is just an expenditure. So all those adjustments are made. Auditor qualifications are also adjusted for in the cash flows. We should come to an example of a ratio-based valuation. I will request all of you to try and compute this. And the idea is that, so in case the sale is 105 and you have a comparable company where the sale multiple is 12.67. Now in that case, you will just multiply 105 with 12.65 and get the value as 1330 as the control value. So this is the way it works, a simple unitary kind of a method where there is a ratio, there is a number that is available for the target company that you are valuing. You might adjust that, make adjustments into that, use the factor and come out with a value for the target company. Any questions on this example? Should be clear to everyone.
Hello? हाँ सर.
So Boji, can you mute yourself?
नहीं आपने भेजा है ना, ठीक है ना? हाँ, कुछ नहीं.
So then we have a test question, which maybe all of you can try and attempt. The Mr. Valuer has been assigned to compute the enterprise value of a listed company at CD Limited, engaged in entertainment industry. The financials for 1920 are as under. So you have sales, you have EAT, you have finance cost, you have depreciation, you have income tax. So there are three competitors, A, B, and C. You look at the EV by Ebitda multiple, EV by sales multiple of all the three companies. So anyone who would like to try this out can kind of try it out. The idea is that these are the questions. So the EV of HCD Limited is to be calculated by considering the multiples of these competitors by using below mentioned guidelines and considering the simple average of EV by EBITDA multiple, considering the median of EV by sales multiple. So EV of HCD Limited as per EV by EBITDA is around how much? So how will you compute this? So you will do what? You will pick up the EAT, you will add, make adjustments for the tax, you will add back the taxation. So after the add back, it becomes 125. Then you add back the finance cost, you add back the depreciation, you get the EBITDA at 175. Then you say that, oh, what is the average? Then you look at the EBITDA multiplied by 14. So the EBITDA is multiplied by the average of 14 to come at a value. Clear? The average is basically the average of the market multiples of company A, B, and C. Is this clear? Similarly, then you can have, for answer B, you can pick up the sales at 2000. Then you can look at median of sales multiple, that is 1.6. Where is the 1.6 coming from? Again, the median of these three values. Then you multiply the 2000 with 1.6 to get a 3200. Any questions on this one? Let me know in case of any question. We should try and make it interactive. If you ask a question, maybe it will also help other participants in grasping the concept quicker. So that was market approach. Any questions on market approach? Anything that you feel you want me to discuss further on market approach before I proceed to the income approach?
Just on the elaboration, in which condition market approach will not be suitable?
Market approach will not be suitable in case of a company or in case of a share where there is no comparable or no close comparable. In case the size of the comparables are very different, the geographical presence of the comparables are very different. So wherever you will not find a person who is doing a job similar to the job being done by a person, the target company, that's where the market approach won't be suitable. Or alternatively, people say that even in case a comparable is available, but you don't have the tools or you don't have the information based on which you can make adjustments in the market value, there also market value does not suit. So in case I go back to the slide where we talked about this, I will just talk about where it does not suit. So transactions involving the subject asset or substantially similar assets are not recent enough considering the level of volatility and activity in the market. Then the asset or substantially similar assets are publicly traded but not actively. Then information on market transaction is available, but the comparable assets have significant differences to subject asset, potentially requiring subjective adjustments. Information on recent transactions is not reliable. They are more of hearsay, missing information, synergistic purchaser, and so on. The critical element affecting the value of the asset is the price it would fetch in the market rather than its income producing ability. So basically, the critical element is that it would rather than the cost of reproduction or the income producing capabilities. In that case, you might like to try market value. But in case you feel that no, the critical part is say income approach, I'm a buyer of this asset or the buyer of this share will or a buyer of this business will buy this business primarily and solely for the purpose of basically understanding the basically for future income rather than based on the market rate or the market price for that property for that share.
So these are the areas that were criteria. So can we use the startup valuation on the basis of listed companies P multiple? So because this is very vast difference. That are the mature company, startup is very starting company.
You can always compare them and you can try and find out that yes, so frequently market approach or market approaches are considered as a check on the DCF. So in case you use an income method, you try to find out a value and subsequently you do a market approach also. The market approach might give you a value which is, very different from the DCF, and that's when you might like to go back and check out your DCF. So in case you kind of determine that the value of a share should be, the P should be equal to say a share like HDFC Bank Limited. Now, in that case, in case your value comes out to be very different as compared to the income approach, you might like to go back to the drawing board and make sure that those differences are real and that value difference is also real. Okay. Okay. Any other question? All right. Let's move on to the income approach then. So the income approach provides an indication of value by converting future cash flows to single current value, and under the income approach, the value of an asset is determined by reference to the value of income, cash flow, or cost saving generated by the asset. And the income approach should be applied and afforded significant weight under the following cases where the income producing ability of the asset is the critical element affecting values from a participant perspective, where reasonable projections of the amount and timing of future income are available for the subject asset, but there are few, if any, relevant market comparables. So that's where the income approach is most used. And the primary method for income approach is discounted cash flow method. And discounted cash flow method, the forecasted cash flow is discounted back to the valuation date, resulting in a present value of the asset. So if I tell you that, okay, you have two options today. One option is you invest 1,000 rupees into an FDR, and I will give you 104 rupees after a year's time. Then I tell you, no, I have another option for you. You give me 100 rupees, I will invest that 100 rupees, I will give it to a real estate developer who is having a difficult time survive, and he is willing to give you 118 rupees next year. Which investment will you choose?
Hmm? 118.
Sorry?
118.
You will choose 118? Okay. Anyone else? So most people normally answer that they will choose the FDR because the 118 option is very, very risky. Why is it risky? Because you understand that it is primarily risky because most of the people they think that when I invest in this kind of an instrument, there is a high probability that there is a credit risk, that in the sense that the value will not come back, and the principal value might also never come back. So that's a risky proposition. Therefore, perhaps because of the added risk, that person is willing to pay 18% interest, but nobody knows where he will earn that 18% to pay the person who has given that money. So in DCF, what do? You say that, okay, today I am, say, as I said, today in case I say my expected rate of return from my assets is 5%, and I'm supposed to get 105 rupees next year. Then you just divide it by 1.05 and you get a current value, which is 100 rupees. So that is what the valuation will become. So what you're in a way doing is just expecting that, okay, what am I supposed to get in future against whatever investment decision or share purchase decision I'm taking, or the value that I'm driving. So I will just put them to the current value, bring them all to the current value, and then get a value out of that. Then there is a concept of terminal value. What is the terminal value? The terminal value concept says that by the end of your projection period, you can't project for the business till eternity because you may not have the foresight to predict that, and therefore you just look at the current system and how the future cash flows are going to come in. What is income capitalization method then? Anyone who can tell me? What does income capitalization method assume? What does income capitalization method assume? The income capitalization method assumes that I will have the same income till eternity in future years, and then you use that income capitalization method to bring the money to the current value, current date. Okay. So basically, you kind of just divide it by the discount factor, and you get a value. So in case there is a rent capitalization method that is very, very famous. So it kind of assumes that the rent will keep growing. So say the rent will keep growing. The rent is say 6 rupees, and say the rent will grow by 5% every year, and you say that your growth and your basically your value or your expected rate of return is say 11%. So in that case, what the capitalization method does is that you just divide your 6 rupees, you divide it by 11 minus the 5, and that is how you will get a value that will be the rent capitalization method or a capitalization method. So you kind of assume a fixed growth in the future. Then you assume that there will be the cost of capital is also fixed in the future. Whereas in case of projection, in case you make your projected period, there you can alter the growth rates, alter the profitability, alter the cash flows that will be generated during that period, so that you get a more realistic kind of a picture. There was a question coming in. Okay. So coming to FCFF and FCFE, what is FCFF and what is FCFE? Anyone who can give me the full forms?
Free cash flow to the firm FCFF and free cash flow to the equities FCF.
Okay, all right, great. I will encourage others to participate, please. It seems that only Chandan and me are in this class. Value of equity shares FCFF. So operating PAT plus depreciation plus interest minus into 1 minus tax rate minus working capital minus capex results to free cash flow for the firm. That is the operating income for the discrete period. You compute the terminal value using a Gordon growth model. You compute the discount rate. You apply the WACC in case of FCFF method. WACC is weighted average cost of capital. Add the present value of the FCFF, add the present value of the TV, add the surplus assets, the non-operating assets, add the cash and cash equivalent, reduce the debt, reduce the specific contingent liability that you have a feeling that will evolve into a liability, reduce the preference shares, divide by the number of equity shares, and you will get fair value per equity share. Any question on this process of DCFF that is on your these steps that are on your screen from anyone? Anything that you don't understand that you want to elaborate on? Then we come to FCFE. So FCFE, then there is an operating PAT plus depreciation and reduce the net debt outflow, reduce the working capital, reduce the capex, reduce the free cash flow for equity. You get the free cash flow to equity, and that is the FCFE for the discrete period. Compute the terminal value using Gordon growth model, compute the discount rate. This time, don't use the WACC, use the cost of equity rate in case of FCFE method. Then add the present value of FCFE plus the present value of TV. Then add surplus assets and non-operating assets, add the cash and cash equivalents, reduce the specific contingent liability, reduce the preference shares, divide by the number of equity shares, you get the fair value per equity share, you divide by the number of equity shares, you get the fair value per equity share. Any confusion between FCFF and FCFE? What changes between FCFF and FCFE? In FCFE, I'm looking at the cash flows that will be available to the equity shareholders. So I'm reducing my debt outflow. Debt outflow will include my interest as well as the repayments that I'm supposed to do. But in case I'm doing an FCFF, there I'm adding the interest to the profit, and I'm saying, okay, let me see what is the total money that will be available to my debt and my equity, and what is the total money available to the entire all the stakeholders on the company, and only subsequently I reduce the debt after taking out the value. The idea behind this is that in FCFF we assume that the money which has been borrowed, that is also part of the cost structuring or to lower the cost of doing business, and that's how it is taken care of.
What's the difference between in FCFE we have reduced just net debt, and here we have reduced total debt as per the balance sheet. In FCFF, this is less debt.
So here we talk about net debt outflow which is being subtracted. Here we are talking about the debt which is being subtracted. So here we are saying that we will just reduce the earnings that we are projecting, and from the earnings we will reduce the debt outflow that is going to go out. Because when my company will earn money, I will end up paying the debt to the people, to the lenders, and I will not get money in the hands of equity shareholders because that money will go out to the bankers. That's where net outflow is reduced from the operating profit itself. But in this case, I am assuming in FCFF, I am assuming that no, debt is part of my life. If I value the equity today, if my enterprise value is reducing or is able to reduce the cost of my doing business or cost of capital by employing debt, I will use that and then I will subtract the debt that is outstanding today. So in this case, you're saying the debt which is outstanding today is not being subtracted, but the net debt outflow is being subtracted, which includes the interest also. Any further questions? I'll proceed forward. So what is the difference? One, we are saying that interest into 1 minus tax rate is added back in PAT. No such adjustment of the interest into 1 minus tax rate is made in PAT. And FCFE, my cash flow that I'm using is already having the interest into 1 minus tax rate element reduced. So I'm not making any changes, but because I was starting from my PAT, I was adding back the interest into 1 minus tax rate in the case of FCFF. Secondly, my debt outstanding as on the date of value is reduced from the EV. Here, the debt outstanding as on the date of valuation is not reduced from the EV because I am already saying that the cash flows that I'll be generating are already after making adjustments for the debt repayment that I have outstanding today. Then debt movement is not captured in the cash flow. Here the debt movement is captured, and then in projected cash flow and terminal value, the discounting they are discounted by applying WACC. In that case, they're discounted by applying cost of equity. Any questions on this difference? So you have a free cash flow, then operational cash flows, which are Ebitda, then less income tax, less working capital requirement, less capex requirement. You get an enterprise value through FCFF. But in case you reduce the interest payment and principal payment for loan, then you also get an equity value, which is under FCFE. So I think all of you understand the idea that equity value is basically equity shareholders, what value do they have, what is the value of business to them. Enterprise value is the value of equity value plus debt minus cash and cash equivalent. Equity value versus firm value. So value of business to all value of business to all of its equity is described as equity value. If we add debts in the equity value, it also becomes the firm value. So the formula is firm value is equal to equity value plus debt value. Free cash flow for discrete period. So one can say that okay, there is a profit from operation that is bad for the discrete period. You add your non-cash items like depreciation, add your interest, 1 minus tax rate, reduce the capex, reduce the working capital, and then you get your free cash flow from operation, which is called CFO. Key steps in DCF, you choose the most appropriate type of cash flow, use pre-tax or post-tax, total cash outflow or cash inflow to equity, real or nominal, you choose whatever best suits your case. Determine the most appropriate explicit period, if any, over which the cash flow will be forecast. Prepare cash flow forecast for that period. Determine whether a terminal value is appropriate for the subject asset at the end of the explicit period. Then determine the appropriate discount rate and apply the discount rate to the forecasted future cash flow, indicating the terminal value, if any. Then, when selecting the appropriate type of cash flow for the nature of asset or liability, one has to look at cash flow to the whole asset or partial interest, pre-tax or post-tax as discussed, nominal versus real, then currency, which currency is the cash flow coming in, those fluctuations have to be captured, type of cash flow contained in the forecast, so all that is normally taken care of in the forecasting that you're doing, and the forecasting has to be compliant with this. So you calculate the DCF on cash flow in functional currency and convert to valuation currency in case there is a functional currency or a valuation currency difference. Explicit period, it can be 5 years, 10 years. It totally depends on the predictability of the explicit period, and also to understand that okay, what is going to change once the explicit forecast period is set. The cash flow forecasts are frequently called prospective financial information (PFI). This is what the abbreviation. The PFI has to be suitable to the purpose, and the valuer is having a duty to make sure that the cash flows are suiting the purpose that they are being used for. So the terminal value, let's come to the terminal value. What is the terminal value? The terminal value is basically when I end my explicit period, I need a terminal value. Why do I need that? Because the normal perception and the normal assumption is that the business is going to go on, and there is no end date on which the business will shut down. Of course, in cases of shutdown also, there can be a terminal value, because even there, after maybe 10 years, if somebody says that the business has to be shut down, then there has to be some kind of disposal value that might come out from ending that business. So in case this NTPC power plant in Faridabad was shut down recently after maybe 25-30 years of its operation, now in that case there has to be a value that that company will get out of that plant once it dismantles it and finishes off that plant. So that's one way of doing it. So constant growth model is one way of determining the terminal value. Market approach, exit value is another way. Salvage value or disposal cost is the third value. This is how the terminal value is computed. The importance is that at the end of the life cycle, end of the explicit forecast period, I have to then use this terminal value to compute the current value or the present value based on this terminal value. Gordon growth model. This is the formula to it. It says, oh, the present value today is equal to the dividend that I will get next year divided by the growth rate minus the divided by the cost of capital minus the growth rate. This is the formula for Gordon growth model. And let's try and do an example. So, company HCD Limited has paid dividend for the year of 11 per equity share. Dividend for next year is expected to rise by 10%. Constant cost of equity capital for the company is 14%. Constant growth rate in perpetuity expected by the investor for the dividend is 4%. The current value of equity share as per DDM method is this much. So tell me which seems to be the right method. So it's 121, and 121 is based on this working where you have dividend for the next year. Because the dividend was 11 rupees in this year, and then you multiplied it by 1.1 because you are increasing it by 10%, you get the dividend for the next year. Then you have a cost of 14%, then you have a growth rate of 4%. You use the formula of 12.1 divided by 0.14 minus 0.04, calculate and get 121. Clear to everyone? Any questions on this? Hope everyone understood the formula. This is something which is very important, and this has to be, of course, absorbed by you, and this will be, of course, something that will be asked very often in the exam, both in practicals as well as otherwise. Then we have another example, which is dividend discount. For dividend discount model, we say for the next 3 years, the annual dividend of stock of HCD Limited is expected to be rupees 4, 4.4 and 5 per share. The expected stock price at the end of the third year is expected to be 50 rupees, and the required rate of return on the share is 10%. So you have dividend, you have cash flows where you're seeing 4, 4.4 and 5, and you're seeing terminal value, you total it, then you say, oh, what is my required rate of return? You convert it into decimals, you add 1 to each of the cell above, you get 1.1, 1.1, 1.1. You compute 1 plus this much, so you basically then multiply it by 3 times. You get the PV factor. PV factor, how do you get the PV factor? You divide 1 by 1.1. Then you divide 1 by 1.1 into 1.1. So 1 divided by 1.1 into 1.1. So that's how you will get this PV factor of 0.91, 0.83, 0.75. You multiply the PV factor with the dividend and the terminal value to get the cumulative present value of cash flows, which here in this case comes to 48.60. Any questions on this one? When you look at the market approach or the exit value, so sometimes it is difficult to use Gordon growth model, or the Gordon growth model is not feasible because you don't have a case scenario where you can say that the company will continue operations for foreseeable future. And in those cases, therefore, what you do is you look at the market approach or the exit value. You say at that point in time, say after 5 years, say after 10 years, in case you choose to sell the entity, sell your shareholding, what will be the value that you'll be getting? That is what then is looked into. Then there is a salvage value or a disposable cost. So where the market value or the market approach cannot give you a value, or you cannot give it an exit value, there you will say, oh, okay, we will have to dispose the business, and you will have to sell each and every part of the business, and sell it in salvage. That is where this will come in. Coming to the discount rate. Now the discount rate is basically talking about the time value of money, but not only that, it also talks about the risk levels. So the discount rate for for money given to a real estate developer who is defaulted will be way higher than a company or a low risk investment like an FDR, because the risk is the difference and the time value of money is therefore different. For the expected returns are different for the investor. How do you compute the discount rate? You develop the discount rate using these various models. One is called capital asset pricing model called CAPM. Then we have WACC, that is weighted average cost of capital. Then we have observed or inferred rates, yields. Then we have a built-up method. Coming to CAPM, so this is then you have then you can corroborate the value or the discount rates that you have come out with using IRR or weighted average return on assets, and that is what then is. We will talk about that further as we move on. So the idea is that capital asset pricing model is widely used throughout the finance for pricing risky securities and generating expected. What does it assume? CAPM, the formula, we will come to the next page, see the formula as well. But the idea is that CAPM says that there is a risk-free rate of return in the economy. And that risk-free rate is normally the government securities, and there it is understood that the risk is very, very low, or the risk is not there for default. And then it is said that the market has a certain rate of return that it is giving on an average. Then what do? You see that, okay, I want to look at the specific risks that are affecting my share or my investment, and then adjust for that the expected market rate of return to find out the CAPM rate. So this is the formula. So it says the expected return of investment is equal to risk-free rate plus the beta of the investment into the market risk premium. So this is the formula of CAPM. All of you have to remember it. There is no other option. And then this is the capital asset pricing model. We will take up an example shortly on CAPM also. Cost of equity, we have CAPM as you already discussed. Then we have modified CAPM. You have a modified CAPM, wherein what you have done is you've added the premiums, or you have added the premiums for small company or specific company premium, and that is used. Modified CAPM is frequently used for closely held targets, where the variation between the other parts is taken with respect to the company being small or the company having a specific unsystematic risk. Now, this is a built-up model. What has happened in the built-up model is that you are no longer using a beta kind of a scenario. You are simply adding risk-free rate with the enterprise risk premium, with the ERP, with the SCP, with the SCRP, and you say that okay, the idea is that okay, let me assume that the risk-free rate is 6%, enterprise risk premium is again 2%, SCP is 2%, SCRP is say 1.5%. So you will get a built-up method. Using that, you will get a cost of or a discount rate that you can use. Coming to weighted average cost of capital, weighted average cost of capital involves weighing the or computing the weighted average of the cost of capital of the debt part as well as the equity part. So in case of the equity part, you have a cost of equity that you just computed using the CAPM model. That is what is being replicated here also. In case of debt, you just reduce the tax shield that you have available in the average debt yield. You get a debt cost. Debt cost is always post-tax. You have a cost of equity. You weigh these two based on the weightage of the debt and the equity in the capital structure of the company or the foreseeable capital structure of the company. Let's say this is the equity plus reserve and surplus 40 lakhs. You have a debt of 20 lakhs and the total on the total amount and the date of valuation is 60 lakhs. So in this case, the cost of equity into the equity plus debt, and so you kind of compute that okay, 15.22% is your cost of equity, 40% or 40 by 60 is the weight that goes to equity, then you have 10% as your cost of debt, then you have 20 by 60 as the weight. You compute this and come out with 13.47% of cost of capital or WACC, and this 13.47, as you can see, is an average of the debt of 10% and the equity of 15.22%. So in no case can you get a WACC which is exceeding the upper limit, exceeding the higher cost item between debt and equity. So we will look at how we compute the present value and reverse it from the future value. So say the future value in lakhs is 100. The rate of interest is 13.47%. That was the WACC that we just computed, which translates into 0.1347. You say that okay, the period is 2 years. So in that case, the formula is the compound interest factor, that is 1 plus 0.1347 to the raised to the power 2, and that comes to 1.287. And the formula for future value after 2 years is 100 into 1 plus 0.1347 to the raised to the power 2, and therefore the future value becomes 128.75. Now the factor of 1.287 is what we are coming out with, and that is what we then reverse working is that you divide 128.75 by 1.287 to come to 100 back. So basically you need to understand, if I invest 100 rupees today and my expected return is 5%, the value becomes 105 next year, and so on. So that is what I am bringing back to the current value, current amount. I think we are short on time to take up this example. Let me go forward and maybe you can take this up later. Value of equity shares as per DCF method. This is how it is basically structured. Where you talk about DCF method, you say, oh, there is a revenue, there is a PAT. So this is a valuation model for your reference. This is how it is normally done. And then you have interest, 1 minus tax rate, add interest, then you reduce capex, reduce working capital, and try to come out with a free cash flow, the firm, and the present value of FCF. Valuation of equity shares, then you kind of go forward, you say, okay, this is the present value of the FCFF, this is the cumulative of the same, and then you kind of come to a value per share. So you can have a look at these models. These are very simple models, which are also the most used models. So have a look at that so that you can have a comfort on these models. And weighted average return on assets. So the weighted average return on assets, or VARA, is the collective rates of return on the various types of tangible and intangible assets of the company. So there is a two-way system. One is you say, oh, you compute a WACC. When you compute a WACC, you're going to your equity and you're saying, oh, what is the value that my equity wants? What is the return that they want? But sometimes it is a concept, and this is an established concept, that the assets which are held by you should also have a weighted average return on assets. So when you say that, okay, you have an intangible asset, you say, oh, that intangible asset should ideally have a higher rate of return as compared to my land and building, which normally fetches very less return. So based on that, you compute a weighted average return on assets, and it is used frequently to check the weighted average that you have for your cost. Coming to IRR, IRR is also a system wherein you can check whether your discount rate is proper or not. So IRR is what? NPV is a concept where you want to talk about net present value. You say, okay, what is the current value of all my future cash flows? In case of IRR, you say that the NPV is 0. And at what discount rate, or at what growth rate, or at what discount rate can the money multiply in such a way that there is no loss, or there is no gain to the person who is investing? That is where IRR comes in. This is the formula for IRR, where you kind of say that, okay, if I want to compute IRR through this formula, that is what I do. Trying to understand mid-year convention. Now, mid-year discounting accounts for the fact that free cash flows of a company are received throughout the year as opposed to only at year end. So the mid-year convention can therefore be a necessary adjustment, since at times the year-end assumptions can be misleading in the portrayal of when cash flows are actually received. So in reality, the cash flows of company are generated steadily throughout the year. However, the exact timing within a fiscal year tends to vary by the company in question and the industry. So what happens is, you kind of say that, okay, the money that I am supposed to get for fiscal year, say for 2023, so 2022-23 fiscal year, the money will not come on March 31st, 23. The money will come throughout the year. So the mid-year convention says that in case I am valuing the company as on, say, 1/4/2022, I am supposed to reduce or make changes such that the mid-year convention does not disturb me, such that the discounting is done based on the mid-year convention, incorporating that. Discount rate, valuer should consider the type of asset being valued, the rate implicit in the comparable transaction in the market, the geographical location of the asset, the life term, the basics of value being applied, the currency denomination of the projected cash flow. Then, in developing a discount rate, the valuer must document the method used for developing the discount rate and support its use, provide evidence for the derivation of the discount rate, including the identification of the significant inputs and support for the derivation or source. Right? So, discount rate is a very, very important number. One has to talk about it, one has to write about it in the valuation report, and one has to give obviously solid reasons or solid ground on how it was computed. The normal system of computing a discount rate is to look at how the industry is doing, what is the expected return that people are having or people are getting from their investments, what is the future expectation, and then altering that based on the specific risks that are relevant to the target company that you're valuing. Any questions on the income method from anyone?
Yeah, one question.
Yes, please.
From RM. In the discount rate, we use RM. So, what should be the preferred duration to calculate the RM? Like in practice, I have seen people using 5 year, people using 15 years, some using 30 years even. So, what's the rationale behind it?
That how many years of cash flow should you project? That's what you're trying to understand.
No. The discount in the discount rate, if we are considering cost of equity, so while arriving at cost of equity, if you are considering CAPM, and to arrive at CAPM, if you are arrive at cost of equity, and if you are using a CAPM, so for that we have to have RM.
Yeah.
So how? What duration should we consider to calculate RM, return of the market?
So basically, the idea is that you normally go long run, where you say that okay, what has been the market doing, or what is the long term return of the market. So some people can say that okay, let me look at 20 years, some can say 15, some can say 30. So the idea behind it is that in case you have a business model where you are only looking at a very, very limited number of years in the future, say 10 years or 5 years, and you say that okay, after that my business will no longer run, then the discount rate can be computed based on the expected return in the near term. That is the limited number of years that you're looking at. Optionally, in case you're looking at an endless growth and you say that no, I am here for a while, and yes, I will be looking at I also want to use the body growth model to compute my terminal value, and I don't have a finite life. In that case, people take it for as long as 15 years, 20 years, because the longer you go, perhaps the more averaging it does with respect to the economic cycles that are relevant in the times. So say there is a risk, right, that in case you take only a 5-year period to compute the expected return, then that 5-year period might be a period of high economic growth. That 5-year period might have various exceptions into it. So therefore, a longer duration is preferred so that all the exceptions kind of average out. That is the rationale of going for the long term.
Okay, understood. One more thing, just to dip in a bit, like we are considering economic conditions of a particular country, and we are well aware. In this situation when COVID situation is there, so we understand. This is a condition which is for everybody across the globe. Right. So this is a bad time for us, and we can consider it. But now what I wonder is like, what should we? Which condition of economic? Condition we will consider as normal condition. Like if an economy is growing at a rate of 6%, 10%, the inflation is below 5%. How we will gauge that thing?
I said, normal cycle. So one sees that okay, take the average of that many years, such that you are absorbing all the economic cycles of growth, peak, trough, and bottom of the economic cycle. And when you take an average of this cycle, you will normally get a value of growth which is more acceptable. So that is, I think, the answer to your question. That averaging it out based on the economic cycles is normally a good idea. And with respect to COVID, what I will do, or I will prefer in case of a valuation where I want to take COVID impact, I will try to take COVID impact in the cash flows itself, rather than bringing it to the discount rate. That's what I will do, because that is very specific, right? And certain industries will be affected much more than others. So I can say that okay, airline industry will continue to be affected for the next 2 years, but maybe if I talk about the restaurant industry, maybe they will not be affected for as long. So I can just take that, put that into the cash flows, and then finish it off.
We just have to have a fair longer period to gauge the economic stability sort of thing.
Yeah.
In 2008 also, there was a dip, so that impacted for 2-3 years.
Yeah.
Until 2010, I guess. So again, it started recovering in the event 2013. So yeah, so one more question. Like what frequency should we consider while calculating RM, like weekly, daily, monthly, yearly data? Yeah.
So you're saying which one should be chosen, monthly, weekly, or?
Yeah.
Totally depends on the data that is available and the accuracy of the data that you have.
Market weekly data is also available, daily is also available, monthly data is also available. So if you are considering say Nifty, so Nifty data is available from 1992, I guess, 91, 92.
Yeah.
And these data are available weekly also.
Normally monthly data is taken in the long going in for 25-year period. Normally weekly data is good enough.
Okay. And should we take CAGR for, or is there any other criteria to calculate
CAGR is good enough. Yeah.
Okay. Thank you so much.
Any other questions on income method from anyone? Okay, let's go forward. So we have cost approach. Cost approach works on the economic principle that a buyer will pay no more for an asset than the cost to obtain an asset of equal utility. That is the concept of substitution. So if I'm getting HDFC Bank as a stock for X rupees, why will I buy ICICI Bank in case it is, say having a higher value, right? Because I will not get the equivalent utility. To calculate you calculate the current replacement of the reproduction cost. Now, this cost approach is very rarely used for going concerns or shares because the income method, the market method become naturally very probable, and that's where it is only cost approach is only more suitable where it is non-directly income generated. So basically, there are three cost methods called replacement cost, reproduction cost, and summation method. Reproduction cost talks about similar asset, cost of similar asset. Reproduction cost method talks about recreating a replica of an asset. So it's closer, basically, it's very accurate to whatever is there. It doesn't look into utility, but it looks into creating a replica. Summation method, you simply add individual values. So say you have an investment company wherein you have 4 investments. You value those investments independently and then add all of them up to compute a summation value. Then cost method, cost approach, asset approach under NAV method. That's what it is done. There you kind of have amount and you have net fixed assets. You have then net asset value. Then you remove the contingent liability, add the appreciation value of investment, adjusted net assets, number of equity shares, and therefore you get a net asset value per share. Replacement cost method, you kind of try to find out what will be the cost of a modern equivalent asset and provide for the various obsolescence that is there, that where how you will reduce there is a physical problem, there is a functional problem, there is an external obsolescence. You provide for all that. In reproduction cost, you kind of then you opt for reproduction where the cost of a modern equivalent asset is greater than the cost of recreating a replica of the subject asset. The utility offered by the subject asset could only be provided by replica. So in these two cases, you use the reproduction cost method, and then you talked about the summation method, how it is used often. Then you have the cost approach method where you talk about how the direct costs and indirect costs are required to be taken care of, and you compute the cost method so that nothing is left behind. Then you have depreciation, obsolescence, and so on. I'll move on to questions. I think all of this is something that is not very relevant for CPA anyways. There's a valuation model. We already talked about a valuation model. This is another version of it where you kind of see that yes, this is how it is computed. So let's try and answer these MCQs. See a PM. What is the correct answer? Maybe you can put the answer in the chat box. Looking forward to as many answers as possible. Anyone? So we have one answer. Alright, I think most of you are getting it right. It is the second one. Then going further, this is the next question. Answer to the next question, please. Most of you have got it right. That's the answer, the highlighted one. Again, you have enterprise value. What is enterprise value? Which formula is the right one? Okay. We have lots of ones. That's the right answer. Then we have an MCQ on which of the following methods is included in asset-based approach or cost-based approach. Right, most of you got this one as well. Then we have an MCQ on the analyst is valuing a firm's equity using enterprise value to revenue ratio of similar firm. Which of the following is not a factor that the analyst should use? It's debt to equity ratio. Then in case of valuation of firms for takeovers, which of the following provides a better estimate of value? Most of you are saying D, that's the right answer. Then there's another one. What adjustment is made while using the discounted cash flow method to value cyclical companies? Yep, normalize earnings, that's the answer. So coming to dividend payout ratio, there are certain questions that come on dividend payout ratio. So you say the PAT is 1,000 crores, the dividend paid is 100 crores. How much is the payout ratio? 10%, right? Payout is 10%. So how much is the retention ratio now? If the payout is 10%, anyone? Yep, 90% becomes the retention ratio. So 100% minus payout ratio is the retention ratio. Relationship of retention ratio and Gordon growth rate. It's a very simple relationship. Growth is equal to ROE into retention ratio. So ROE is return on equity example on the next page. So So growth rate is equal to ROE into retention ratio. So ROE for the company is 20%, retention is 90%. So in that case, the growth rate becomes 18% based on this formula. Similarly, if the retention ratio is 50% and the ROE is 20%, then it becomes 10% growth rate. Okay, which one of these is correct? This is the second one, okay? Income capitalization method. We'll talk about income capitalization method, where we talk about capitalization method is a method where you value a firm by calculating the expected future maintainable profits, and one-time events, non-recurring events, all these are ignored. And basically you see that, okay, what is going to happen in future, and then just put that, say that, okay, this is going to be the long-term growth rate, and computed based on that. Then you adjust for the actual historical cash flow, non-arm's length transactions, and so on. So that's about it. Any questions? I can answer those. Any unanswered questions which were posted by somebody in chat box, you can ask them. I can take them up, and I think we are well within time to finish the session.
So if any of the participants has any query for the session conducted by Ankit ji, they can either unmute themselves or they can ask in the chat box. So Ankit ji, I believe if anyone has any query, they can ask. They will be asking you directly otherwise. So
Not a problem. Sounds good.
So thank you for taking out time, your valuable time for assisting.
So it was my pleasure to interact with so many of the participants. Of course, the questions brought in a good number of chat boxes, and we are used to those physical seminars where you have everyone interacting. So
Yes.
it always feels odd to speak to the computer, and I think that yes, I encourage all the delegates who are part of this session to have more interaction with whoever is coming here today and tomorrow, so that you can all increase the participation in the system. So it was a pleasure here. Thank you, Manas, for giving this opportunity. It was my pleasure to be here and interact with everyone.
So Ankit ji, kindly share the PPT as well. So that
I will share it on the group shortly after the session ends.
Sure. Thank you so much for taking out time and providing this wonderful session to all the participants and guiding them for what exactly is the important approach, not only in the examination but also the valuation as well. So thank you so much. Thank you all the participants for joining in. The next session tomorrow, because of the tomorrow is like 15th of August, so that is where there will be no session tomorrow. The next session will be on Monday. That will be from 7 to 8:30. And the schedule for the whole session will be provided in the valuation group that we have created for all the participants. So thank you Ankit ji. Thank you for joining.
Thank you everyone.
Thank you everyone. Thank you.